Time for hot picks, and we're looking at energy stocks. Our guest has Peyto exploration as his top idea. He just increased the target price. Let's get more from Bilkoski, analyst at TD Cowen. Aaron, thanks very much indeed for joining us.
Thanks for having me. So there's been an incredible amount of geopolitical uncertainty this year. This has created a ton of volatility. What I wanted to focus on today are a few names that are defensive to that global macro environment and have catalysts coming. Peyto absolutely checks that box. Peyto is a high-quality natural gas.
Sorry to cut you off there, Aaron. Yeah, I think you were going to say this, but they're a classic natural gas play in Canada.
Absolutely. 90% gas. They have assets in the Alberta Deep Basin. Peyto's momentum as a company really started to accelerate in 2023 when it acquired the conventional assets of Repsol. This was pivotal because these assets were very undercapitalized, and Peyto, being a high-quality, competent operator, applied its own field practices to these properties. And we're now seeing the benefits of that. The company has significantly increased the average well productivity on these areas and has driven costs down. And there's a few things that make Peyto really special in its class. It has the lowest corporate capital costs. It has the lowest corporate average gas expenses. Despite the fact it's primarily a dry gas producer, it has the highest full cycle cash margins when compared to its peers. And they have excess infrastructure. So they have twice the natural gas processing plant capacity that they need today. So while many of its peers are going out and spending capital on natural gas plants to grow, they already own these facilities. They simply optimize and fill what they already have. This means the business is generating significant free cash flow that's being redirected to single-digit growth, about 9% year over year, and a 6% dividend yield. Its cash flow is very stable, as you alluded to in your intro comments. It's about half hedged this year at a gas price at about $4. And as those hedges roll off the books, they should be rolling into a higher than current Canadian natural gas price environment as LNG Canada continues to ramp up. And hopefully as we start to see other projects come on stream, whether that's Cedar, Woodfibre, LNG Canada Phase 2, or Salisms.
Let's move on to your next name, ARC Resources. They too are well known for gas exposure. What draws you to that stock?
Yeah, so I think ARC is one of these classic examples where the market has overreacted to a relatively small disappointment in the field. So the background here is that ARC has been building out a new area called Attachie over the last couple of years. It was supposed to ramp up to about 40,000 BOE a day. Unfortunately, it's been tracking about 30,000 BOE a day. Quite honestly, it's been an uncharacteristic hiccup for a really high-quality operator, ARC. But I think we need to put that hiccup into the context of the broader business. ARC's producing over 400,000 BOE a day. We're talking about a shortfall of less than 2% of the company's production. Yet its share price has underperformed its peers by 30% since these challenges came to light mid last year. It doesn't change what makes ARC differentiated or special. ARC is the single largest Montney pure play in Canada. It is the single largest Canadian condensate producer. They're the only Canadian independent with a direct supply agreement to LNG Canada. Plus, they've signed a basket of future LNG deals with Cedar LNG here in Canada and Cheniere in the Gulf Coast. So as I look ahead, I see a share price that's well supported by healthy free cash flow. At current pricing, they're paying a 3.5% dividend yield. They can repurchase about 2% of their shares outstanding with excess free cash flow this year. While we wait for more data points that show improvement at Attachie, or the market to more rationally price in the small challenge at Attachie, and as I expect, Canadian natural gas price fundamentals to improve as LNG Canada continues to ramp up.
Attachie is what? It's a crucial price setting point for gas?
No, Attachie is a Montney area in BC. It's a condensate-weighted Montney area that they've been building out for a couple of years now.
Can we move on finally to Prairie Sky Royalty, where we're looking at a yield of about 4%. Is that one of the things that attracts you here?
It's one of the things, but I think bigger picture, owning energy assets through royalty entities is a fantastic option. This is essentially the same way governments around the world receive value from their oil and gas resources. So in its simplest form, Prairie Sky owns mineral interests across about 20 million acres of land. A large portion of that is held in perpetuity, and it's Prairie Sky's job to lease out that land to oil and gas companies who do all the field work and assume the risk. So Prairie Sky simply takes a portion of the production on its lands. This means, unlike traditional oil and gas companies, Prairie Sky has no reoccurring capital expenses, no operating costs, no transportation expenses, no end-of-life abandonment expenses. Outside a small amount of G&A and corporate cash tax, all the revenue they collect is free cash flow that's used to pay dividends, buy back stock, or make tuck-in acquisitions. So despite all those benefits relative to a traditional E&P, Prairie Sky currently trades at a free cash flow yield of about 5.5%. That's better value than the Canadian integrateds or the Canadian conventional E&Ps, which trade down to about 5%. Personally, I think this is just a fundamental mispricing of risk. So from a shareholder's perspective, you're right. You're getting roughly a 4% yield, but also they're growing the business about 4% year over year without investing any of their own capital.
We'd better leave it there. Aaron, thank you very much. You gave us a lot of information in a short space of time. Really, I love the information density. Thanks very much indeed. Aaron Bilkoski, analyst at TD Cowen.